So now here we are. We were able to walk through our financial statement. We have done part of our valuation methodology. So we want to move on to constructing our discounted cash flow methodology. We were able to walk through the comparable company analysis, and we will later on use that to determine our sum of the part methodology, which is part of our primary valuation methodology. So we will walk through discounted cash flow analysis, and then we will later on move on to sum of the part analysis, and then we will move on to precedent transactions, which are our primary evaluation methods. And then we will later on move to our secondary evaluation methods, which are equity research target prices. And we'll also take into account the current market prices of Amazon, the 52 weeks current market prices. So we're going to be doing that based on our data which we will get from Yahoo Finance. So we're going to be doing all of this year. So let us begin with our DCF analysis. So as you can see, we were able to extract the free cash flow to the firm. So we were able to come up with the free cash flow to the firm, and we want to now use that to determine our discounted cash flow analysis. So for the DCF analysis, there are two things that are very important for us. First is the weighted average cost of capital, which is our discount rate. So we're going to be using that to discount future cash flows heavily back into the transaction date. So the present value of those future cash flows will be discounted using the discount rate, which is our weighted average cost of capital. So we're going to be determining the weighted average cost of capital based on our comparable companies unlevered beta. So we will grab our comparable companies unlevered beta, and then we will have to relever the unlevered beta to determine the weighted average cost of capital for Amazon. So as you can see, we're going to be talking more about that as we go forward, determining the weighted average cost of capital. So the second thing that is most important here is to determine our terminal valuation based on go-down growth model. So we're going to be using the go-down growth model, where we estimate that the cash flows will grow past the year 2031, which is our terminal year of this valuation. So we believe that the cash flows of Amazon give its high growth prospects. We believe that the cash flows will grow past this terminal period, and that is why we will use the perpetual growth formula, which in this case is the go-down growth model, to determine the terminal value based on our assumptions if these cash flows will grow in perpetuity. So we're going to be doing that so we're going to be working on that now. So let us switch to our control panel here, where we will bring in some terminal value methodology. So we will begin here with terminal so the terminal value here we set this to be so this will be the exit multiple and then for the next it's gonna be we'll set this to be the perpetual growth. And then for the next we're gonna take the average. So essentially what we are doing here is we are setting a toggle for our terminal value so that in the model we will know if we can switch in between these toggles if we want the terminal value to be calculated based on the exit multiple, or we want the terminal value to be calculated based on the perpetual growth, or we want the terminal value to be calculated based or to be determined based on the average of the exit multiple and the perpetual growth. And then we can just set this to be 1 for the index.